Hello, myself Rupali Gupta, Assistant Professor of Economics working at GFGC Chitrahalli in Chitradurga district. Now, I would like you to listen to a small story of a boy, Vardharaj. Vardharaj was a boy whom I had seen very sad, very upset. I asked him several times, what are the reasons behind your depression? Why are you sad? But he never answered. One day I saw him walking towards a well. And when he reached the well, he saw the well was very old and the lining around the well, the wall of the well, was very thick, was very strong, like the old wells we had earlier. And he also found a sage sitting near the well. But he didn't speak anything. But the sage saw him a kind of depressed, a kind of upset. The sage itself called Vardharaj to him and questioned what happened here. Why are you so sad? He explained all the problems to the sage. I was very surprised to see that he explained the problems to the sage. And sage in reply said, I have a solution for you. He said, this is a well which has water. Kindly pull the rope, use the rope, take the bucket of water and have some water. Your problems will be solved. And Vardharaj was very happy because he was very excited to sort out his problems. He did the same. He used the rope, he pulled the water through the bucket and had the water. And after 5-10 minutes, he's seeing then also there is no change. Why? What is the change over here? Then he finally asked the sage, I had the water, but my problems are not still solved. I am still not feeling good. Can you explain me what was the reason behind you telling me to drink this water? Then the sage mentioned, are you seeing this rope that is there on this well which is pulling the water every day? He said yes. Then the sage asked, can you compare the strength of this rope and the line of the well, that is the wall of the well, which is more stronger? Vardharaj replied, well's wall is more stronger than the rope. Rope is feeble in front of well. Then the sage showed him an imprint that was created by the rope on the line of the wall. He asked, how do you think this line is being created? Then he didn't understand what the sage is asking. He said, this rope has done it because we keep pulling the water, we keep dragging the water. He said, exactly. You have left hopes by trying 1 time, 2 times or 3 times. But this rope, which is most feeble in front of this wall, has been every day dragging water and has been creating imprint on the wall. So, you should never give up. You should keep trying. There should be consistent efforts. Then, one day, knowingly, unknowingly, you tend to create an impact in your world, in your society, and have some difference. Hence, over here, I would like to quote small kavita or doha. Over here, karat karat abhyas te jadmati hoye sujan, rassi avat jaat te seal par pade nisan. That means to say, the way you keep doing practice, you become perfect. And jadmati bane sujan means, even if you are buddhu, you become intelligent one day if you have your consistent efforts towards gaining knowledge, towards learning something, towards doing something. And how the rope every day by coming and going has created impact on the well, on the lining of that well, on the stone. The same way you will also create an impact, an imprint of yourself in this world. So my dear students, I would tell you and keep reminding you that you should never give up and keep trying till you succeed. Now, let's start with the topic that I have for you today. And today's topic is components of money market. What are we going to study? Components of money market. But before starting the concept of money market and its components, let's understand what is money market. Now, money market. You may say, ma'am, it's so simple. Money market, a market where money is being sold. Oh, really? Do you think it is a market where money is being sold? No. this is a misnomer where we are just using this term as money market. But it is a market where some kind of financial securities are being traded. And these financial securities have been traded for short period of time. Short period means how much? Within 1 year. That means to say they are bought and sold for a period of 1 year. And they are highly liquid. Highly liquid means to say they can be easily converted into money. Not only that, they have higher value. They have a bigger face value. So money market is a system, is a setup where financial securities are traded for short term, and the short term over here implies less than 1 year, and they are highly liquid in nature. Now, coming to further, then what do we understand by components of money market? But hold on, before going to the components, we need to understand who are the involvers over here, who are the sellers, who are the buyers, what are the instruments. Before coming to the instruments and components, so the issuers are government, banks and corporate houses. What are they going to do? They are going to sell the financial securities to the people, to the banks, to the companies, to the non-banking financial institutions. So anyone in the market can purchase these financial securities. The issuers are three, the buyers are n number of people or organizations also. So when we are talking about money market, at one side you have the issuers, the ones who are going to issue the money market instruments, and the other side you have the buyers who are going to buy these issued financial securities. So the buyers include people, banks, non-banking financial institutions, companies also. Now let's look out what are the functions of money market. Firstly, it provides funds to those entrepreneurs, the organizations which are looking for immediate financial help and are looking out for only short period of time. And it also helps them who want to utilize their surplus funds. Like banks usually have surplus funds, or some organizations, profit making organizations also have surplus funds, but they don't know how to utilize that. This money market provides a platform wherein they can be using their surplus funds by investing in money market and making more profits. Not only that, by having money market we have lesser dependence on the banks. That is, we don't have to be completely dependent upon banks for taking loans or meeting our fund requirements for short period of time. And it also helps in monetary policy by stabilizing the demand and supply of money supply in the economy. Usually when we talk about monetary policy is going to make sure that money supply has been regulated in order to maintain economic stability and price stability within the economy. But by maintaining the liquidity in the market, money market helps us in maintaining the monetary policy or maintaining the price stability in the economy by regulating the money supply. And it also helps the government may encounter such situations where government will require to have a great amount of funds, but immediately they may not be able to raise it through loans within the economy through financial institutions, or they will not be able to be borrowed by the international institutions. Money market instruments provides an opportunity to the government wherein government can immediately raise good amount of funds, that too at a very low rate of interest. Then it also maintains the financial mobility. We have been seeing people do have money, but they don't know how to utilize the money and where to invest, how to invest and how to make profit out of it. Money market provides a very flexible platform to those people who have surplus funds, and they can move their money from one source to another source and keep earning profit within a very short span of time. So these are the functions. Along with this, the other functions are maintaining the equilibrium between demand and supply. The demand and supply of cash, that is, usually people demand for cash, supply for cash. The demand and supply equilibrium should be equal. That is, there should not be higher demand of money compared to supply and higher supply compared to demand. It ensures price stability.
And money market instruments are in short going to help maintain this equilibrium of demand and supply of money. Not only that, it also helps the companies eradicate, sort out the short term deficits. We have seen some of the companies immediate requirements of funds for short period of time obstructs their way of working their production process, but money market helps them raising funds for short period of time and meeting their short term deficits. Not only that, it also helps the central bank in regulating the liquidity, because central bank always aims at maintaining a greater liquidity in the market so that none of the businesses, none of the work procedures suffer, none of the entrepreneurs suffer, and none of the businesses fail down to continue their production process. Hence, money market is a very effective instrument in regulating the money supply, which helps the central bank in maintaining the price stability, economic stability. It partially does the work of monetary policy as well. And reasonable rate funds, that is, we get over here funds which are at reasonable rate. Many a times when we compare of taking loans through banks or any other financial institutions, a lot of procedures are also involved and lot of complications are also involved, but compared to all that, money market is an easy platform where people do get amount of funds that they require, that to big amount of funds that they require at reasonable rates. And it helps in developing the capital market and further commerce and trade. Not only the money market is going to just help out in running the money market, the instruments of money market is also going to help capital market and overall growth of trade, commerce and other business houses. So in short, these are the functions of money market.
Getting it clear? Now, moving ahead further to what are the components of money market. Now, when I'm talking about what are the components of money market, we need to understand it like an orange. Let's peel this orange and have one by one its slice to understand what are the money market components. So, now let me have the first one over here. Now, the first slice over here is going to refer to the call money market. What is the first component over here? Call money market. So, when I'm talking about call money market, what do you understand by it? It is a market where we are seeing the money or the financial securities have been borrowed for a day or less than 14 days. I again repeat, it is a market system where the money has been borrowed by the banks, by the corporate houses for the period of 1 day to 14 days. So the span of money market, that is called money market, is between 1 day to 14 days. Getting it clear? So when I am talking about call money market, if the money has been borrowed for a day, say today it has been borrowed, tomorrow it has to be returned, then it is called as overnight call money market. And one more interesting fact about call money market is, in call money market, we are seeing that holidays or Sundays, government holidays are excluded. So if I'm taking a span of 14 days, I'm taking 14 working days. I'm not going to include Sundays or any official holidays declared by government. Getting it clear? So call money market is a setup where money can be borrowed for 1 day to 2 weeks, 1 day to 14 days, not beyond that. This is the most volatile market, but the returns in this market are very high. And the borrowing is not made for small amounts, it is made for huge amounts. And this amount of borrowing, loan taking is done as a settlement, temporary settlement. There will be reserve shortages which will be created immediately by borrowing for 1 day, 1 week or 14 days. So this is called money market. Now moving on further to the next component. What would be the next component then? It should be interbank money market. Interbank term money market. Now when I'm talking about interbank term money market, what does it imply? It is a transaction that is being taken between bank to bank. Banks are trading among each other in order to meet their reserve shortage or the shortage of cash that they have. For example, there is HDFC Bank, there is SBI Bank. SBI Bank has promised a big corporate house to sanction a loan of 500 crores. It was expecting that the other loans which it had sanctioned, it will get it back. But unfortunately, it did not get at the time when it has expected. There is some amount of shortage. So at that point of time, they have already a commitment in front of them that they have promised the customer to give a loan. So what they would do? They would say, no, we still don't have the money. We cannot come after 1 week, come after 10 days. Can they say that? No, it's unprofessional. They can't do it. In that case, what do? They come up and they mention that we are going to take loan from HDFC Bank for 1 day, 1 week or 14 days, and within that span they return back that money on a high rate of interest. So this is called as interbank term money market. Now moving on further to the next component. So the next component over here is the Treasury bill. What is it? Treasury bill. This is an interesting concept because Treasury bills are the only one component which are issued by whom? Which are issued by the government. Government issues these T-bills. They are popularly called as T-bills, that is Treasury bills. What are Treasury bills? Treasury bills are nothing but an agreement which has been sanctioned by the government, which is promising to pay some amount of money. It's like a bearer instrument. One who has it will get money for it when the maturity is over. Okay, so when I'm talking about Treasury bills, in case of Treasury bills, what is going to happen? In case of Treasury bills, the government is going to write an agreement wherein in the agreement there will be some amount of stated, like the face value would be stated, say 1000 rupees. The value of that T bill is 1000 rupees, but it will be sold to the customer at discount on the par value. That means it will not be sold at 1000 rupees, it will be sold by less than that. Why? Because if you are selling at less than that, at maturity period, the face value will be given to you. So that is itself your interest. Suppose I am taking a Treasury bill with a face value of 1000 rupees, but I don't pay 1000 rupees for it. Say I am paying 800 rupees for it. So on a particular Treasury bill, what is my earning? I am earning 200 rupees. Similar kind of Treasury bills, if I have 10 or 20, immediately I am going to mint the money. So this is one of the safest investment in money market instruments. Why? Because in all the instruments of money market, there are chances of risk, there are chances of volatility, but in case of Treasury bills, it is an assured sum of amount that you are going to get. And Treasury bills are given for various periods, and the periods are 4 days, 14 days, 91 days, 182 days and 364 days. Again, let me remind you, it is within the span of 1 year. It does not cross the span of 1 year. I again repeat, 4 days, 14 days, 91 days, 182 days and 364 days. Now, moving on further to the next component. So, are you interested to have this juicy orange? Okay. Now, the next component of our money market is certificate of deposit. What is it? Certificate of deposits. Now, this is again another second safe money market instrument which has been issued by whom? It has been issued by the banks. The banks are going to issue. This is a negotiable instrument which promises again to pay us an amount. The amount which will be stated on the face value, but it's not being issued by government. It is being issued by whom? It is being issued by the banks. It works similar to Treasury bills, 100% similar to Treasury bills, but it has a bigger face value when compared to Treasury bills. And we usually observe the corporate houses, big business houses purchasing or trading these certificate of deposits. Or the people who are multimillionaires, very rich, only they tend to come forward. Why? Because the face value goes beyond lakh. One certificate of deposit is not less than 1 lakh. It goes up to crores together. Hence, when we see the trading of certificate of deposits, we see less number of participants. If participants are there, they are financially very, very strong. This is certificate of deposit. It is a bearer instrument which again promises you to pay some amount when there is maturity. It is a time security. It is not a demand security. It's not when you want you get the money. Like if you have shares, you sell it, you get money. But it's not like this. This is a time security where you buy it after the maturity period, you get your amount, you get your face value. Now, coming to the last component of money market. So this is the last and the most juiciest piece over here, that is commercial papers. So when I'm talking about commercial papers, what do we understand by commercial papers? Commercial papers are unsecured promissory notes guaranteeing amount of money to the bearer, but issued by whom? By the corporate houses. Now this is a little tricky one. Why? Because this guarantees us to pay money, but the guarantee is dependent upon the profits, on the performance of the company. So over here what happens is, it is completely dependent upon how the performance of the company goes, and accordingly the profits will be given. Because here face values will not be mentioned. Here the percentage of profit will be mentioned. So the company, when is going to make any profits, what is the percentage that will be assured to you will be promised. Hence we say this is unsecured promissory notes, and these are not issued by banks or government. This is issued by whom? By the corporate houses. This is again an instrument for them to raise short-term money. It's a volatile market where you're going to just raise money for short-term period, for 1 day to 1 year, that's it. But in this, the risk of investment is involved. Hence, we have seen the concept of mutual funds coming up. Because when we see commercial papers being launched, we don't see much of the companies coming ahead and purchasing it. We also don't see much of the investors interested in purchasing it. Why? Because they are not assured of their returns. They are not at all assured. I'm investing today, say, 10 lakhs on commercial paper. Tomorrow the company does not perform well. Is it my mistake? No, but then too I lose money. So in that case, what is going to happen? We are going to put our money on a greater risk. So the commercial paper concept was a kind of failure. Hence the concept of mutual funds came up. But mutual funds is not a component of money market. Let me remind you. Mutual funds are the companies that are going to take such proposals from the corporate houses. They are going to break up into further schemes and policies and are going to sell to the customers. And not necessarily for 1 year, it could be for 5 years. The mutual funds are going to take the risk on behalf of customer and the corporate house. Hence, we say over here, people are more interested in purchasing mutual funds. Why? Because they have been assured by the company some amount of profit. But the risk involved in commercial papers are higher, which cannot be estimated as well. So these are the beautiful concepts of money market. I again repeat, what is money market? It is a setup where you are going to trade financial securities. What are financial securities? Any security, any agreement that is going to assure you some amount of money at its maturity. You have a paper which states this amount you are the bearer and you will be getting the money at the maturity period. That's called as a financial security. These financial securities in the money market are traded for less than 1 year. Less than 1 year. And they are highly liquid. They can be easily converted into cash. And moving on further, this is a volatile market. What do you mean by volatile market? Lot of fluctuations are observed in interest rate on the auction day, the prices changes. So this is a lot of volatility observed in money market. Next thing, the issuers are bank, government and corporate houses. The buyers could be people, investors, banks, NBFCs, corporate houses, anyone. And the instruments are call money market, interbank term money market, treasury bills, certificate of deposits and commercial papers. So you have 5 components. Getting it clear? So this is a very simple concept where you can connect it to the live examples as well, and we'll move on further to the next topic in the next class. But before moving to the next class, if you have really understood what I have taught you, in the comment section below, kindly let me know. Money market instruments are sold for what period of time? Is it 1 year, 2 years, 3 years, or 1 week? So I'll be waiting for your answer. I again repeat my options: 1 year, 2 year, 3 years, or 1 week. What is your right answer? So good luck, keep studying, happy learning, keep growing.